Okay, I think we just start. Okay. Thank you very much for joining. Good morning, everyone. So we have a couple of person here. I think we just start now. So it's already 10:36. So this round, the questions, okay, there are a couple of questions, but some of the questions are easy, some not so easy, but I'll try my best. But before that, before we go to the Q&A, just do a quick walkthrough on what happens during the week now, okay? So this is S&P 500. So over the past 1 week, went up by 1.56%. So towards the end of the week, there's small rally here. And based on the pricing of crypto, I think today, it seems like market, there's still like continue this small rally. So I think early, like tomorrow, early next week should be green as well. Okay. And for QQQ also went up by 1.56% over the last 1 week. 1.56 and 1.56. So similar, like exactly the same level. Quite interesting. Okay, just a quick look at the chart. Then I think just want to go through this first question. Actually, I know these first questions came from Chiking, but I think he's not able to join us. But let's say if he joined the session later, right, then maybe we can discuss in more details. Let me read out the question first. What happens if S&P 500 earnings drop by 30 to 50% and multiple shrink? What's your view on the probability of that happening? So actually, he shared the video of one YouTube videos. Later I share in the group. So basically I think that's one is just an analysis to say, okay, under a bearish sentiments, right? I think he quoted that the S&P 500 may drop to 2,000. Right now, I think S&P 500 is at this is SPY. It's about 4,000, right? So in order to drop to 2,000, that's around 50% drop. So if you look at 50% drop, it sounds like, okay, it's very scary. It's like, okay, it cannot be. It's too much, right? That kind of, it's a big crash, right? But his argument is basically, if we only need the earnings to drop by 30 to 50%, and then let's say like the multiple drop by another 30 to 50%. So if you just work out the maths, then yes, S&P 500 could end up at about 2,000 level. So I think the number is S&P 500 earning per share drop to about 100. Then you just multiply it by a conservative multiple, right? So 2,000 is definitely possible. So the question is more like, okay, is it how high is such probability, right? Is this something that let's say I think will happen? So I think my questions to my answer to that question is that, okay, definitely under a bearish scenario, this could happen. It's just that it shouldn't be the base scenario, because if you just observe what's happening in the market, right, or in the economies, right, yes, there's some slowdown, but it's not to the extent that the earnings will be expected to drop 30 to 50%. So
has
this
that
is
ever happened in history?
So let's pull out this chart, right? So I think definitely it has happened before. Yeah, but it has to be a serious recession. So this chart, right, I actually pulled out from Yardeni. I think this Yardeni, right, if you go to websites, right, there's a lot of all these charts, very helpful charts to help us understand the economy, the market, and so on. So this is, so I just want to explain this chart first. So the red line, right, this is actually the earnings, what is it? It represents the earnings. It's just that I don't know whether it's earning per share or earnings, but doesn't matter. It is still, let's treat it as earnings. Then the blue line, right, is just that, sorry, I need to correct my statement. The red one is the index. The blue one is the earnings multiplied by the multiple. For example, if I take the earnings of that year, right, then I multiply by 10, this will be the line. Of course, if you multiply by 24, it will be higher. So from this line, you can see that where the multiple is, right? So if you look at the blue line, everything dropped during, let's say, 2008 and 2009 from, let's say, just take one line here, from about 1,006, it could drop to, let's say, around 1,000, right? That is almost like 50% drop already. But if you look at, I think, a more serious EPS a more serious recession in the past, right, it could drop in the magnitude of 30 to 50%. So this one definitely happened in the past. It's just that it is something like a big crisis, then only we will see like 30 to 50% drop. Of course, single company is much more easier to drop. Let's say even 100% drop from positive earning to negative also possible, right? But this is talking about broad market. So you can take the red line as a gauge on how much it could drop during a crisis. And then here during COVID crisis also we can see it drops, right?
So,
but it's not to 50%. Yeah.
I read the chart. It seems to be. Sorry, my son is throwing stuff. The red color line is the SP 500. It's the index.
Correct.
The blue color line is a multiplication of the SP 500 with estimated forward PE ratio. So that's why it's implied, right? But that doesn't represent an actual earnings drop. It just represents what the earnings drop would be. I suppose it's usually actually using a forward PE ratio. I just find it very unbelievable that the earnings for all 500 companies would drop on average 50%. That is
okay.
Quite...
Let me correct a little bit here. So the blue line, right, it's basically the blue line is the EP forward earnings multiplied by, let's say this line, right, the bottom one. This is the forward earnings multiplied by 10. So how much this drop, right? It represents how much the forward earnings has dropped. But the actual earnings, right? Oh, actual earnings is here. Sorry, I have another chart. So the actual earnings it could drop even more because usually when it comes to forward earnings, this one represent the analyst estimates, right? So usually it's like milder. They typically don't expect a huge or big movement. But the actual movement, which is the blue line here, it could drop by 50%. You can look at here. This is about 95. This is, I don't know, about 40, something, even lesser, right? Later, I can pull out the numbers. I don't have it here. This is all chart, right? If you look at the EPS, let's say EPS historical, right? So, I think I've seen it before. The Y chart, I think we'll have it. This one is the past. So you can see here, right? 2000, but they don't have so... This one, I don't have the account. Also don't have here. But later I'll share it. I don't have it here. But you just look at the chart, you can roughly know, right? You see from this level, drop to this level, it's definitely more than 50%. So. But these are serious recession, right? 2008, 2009, people losing jobs, that kind of situations. It's not like a base like scenario, right? Sorry, Jay, can you please mute? Yeah. So come back to this. Historical earnings definitely dropped 50% before because of all this operating leverage, right? But if you look at this forward earnings, it also dropped drastically before. So like 30 to 50% drop is something that is not like it definitely could happen because it's not like all 500 companies drop by 50%, because there are some companies that will drop to negative, right? So if you average out a negative numbers and then, of course, you can have an average that drop by 50%, right? Typical Singaporean, are you still here? I hope that I answer your question. So
yeah. Do you think I can? I actually have the link from Nasdaq showing SP 500 earnings by month. Do you think I can show my screen?
So I
Sorry. My kid is pulling the microphone.
Can you share the screen? Can you share the link to the chat group and I copy paste? Because if you share the screen later, you mess up with the screen.
Yeah. Okay. I think it tallies up with what you just said. There is a 50% drop in the 2000 crash, another long drop during the Depression, and one more drop during 2008. But otherwise, those are the 3 times where earnings do drop more than 50%. It seems 3 times.
You haven't unmute your microphone. Bunji, you haven't unmute your microphone.
Okay. Thanks. Yeah. Where were we? Where was I? Okay, just to come back, right? Earning per share has dropped before, and it could drop by 50% on a broad index level. So this definitely happened before. But are we expecting this to happen? Let's say if we just stand on today's, right, which is 11th of September, right? Based on the economy, based on the job market and so on. So I don't think we should expect to see this kind of drop. But things could turn out to be worse in the coming months or quarters, right? Or it could improve, right? This one we don't know. But just look at the history. It has happened before. And let's say it happened again, earnings drop by 30 to 50%. And usually this one will coincide with the multiple drop. Hence, an index drop by, let's say, even like 50% is not something that is crazy. I mean, it definitely happened in the past and could happen in the future. And come back to this chart, right? This chart, actually, we can see clearly, like, let's say before the as of 2007, right? You see the multiple is around 1, 2, 3, the third line, right, which is about 40 times forward earnings. But during the crash, right, 2 things happen. One is that the forward earnings will drop because the economy or the corporate's profitability all drop, right? Earnings drop. At the same time, right, the multiple also dropped. It dropped to the, let's say, about 10 level, right? So you multiply these 2 effects, then you will get a huge drawdown in terms of the S&P 500 index. So this one happened in the past. You see 2019 also similar. Just before the COVID crash, right? The multiple is around 1, 2, 3, 4, the fourth line, right? Which is about 18 times forward earning, 18 to 19 times. But as of 2020 bottoms, right? It drops to about how much? This is about 14x, right? So the multiple also shrink, and then the earnings, the forward earnings also shrink. So they tend to move together, one. And as of now, you can see that the earnings haven't really dropped. It just like slightly dipped a little bit, right? It's not like huge drop, right? It's nothing compared to during COVID crisis and during the 2008-2009 global financial crisis. But the multiple has shrunk because I think to a certain extent, the market also expect that the earnings over the next 12 months will be a lot weaker now. And hence the valuations already like the sentiment and the sentiment has already turned negative now. So this is something that I just want to, like, the entire videos, I think about 10 minutes, what they're trying to say is that when you have earnings drop together as your multiple, and that's when you can get a huge drawdown. But when the things improve, right, once you have the earnings slowly to improve, then your multiple will also improve, and that's when you get the index also can rally up, right? So similar to the period during 2020 and 2021. You see the multiple quickly already went up, but this is also thanks to the all the quantitative easing and so on. Yeah. So I think that's the first question. I don't know whether typical Singaporean or Boon Song, do you have anything to add on this? On the first one? Okay, if not, then we just continue. What are the scenarios for the markets in the coming months? Well, this is talking about short-term kind of outlook. I don't know. I think for me, right, I don't. But when we come up with scenarios, of course, we can come up with bearish and then bullish scenarios and then bearish scenarios, right? But it's always, if you come back to this chart, right, it's always like, okay, if this one continue, the earnings, the blue line continue to drop, you just look at what happened during the past crisis and just duplicate the same. Of course, you can paint a very bearish scenario, right? But the same could happen during the normal period. For example, let's say during 2011, right? You see the index also dropped here. And then after that, the earnings just continue to go up and go up. You see all the blue line went up during this period, right? This is earning going up. Means the economy doing good, corporates doing good, and then multiple going up. Hence, market essentially rally during this period, right? Same thing could happen also from 2023 to 2025, right? Who knows, right? So I'm not trying to predict. I'm just saying that you can always look at the history and then whether you can take a bearish period, a crisis period, or you can take a market rally period and just extend and make up your story, right? But basically, these are the story that we can tell ourselves now. But I'm not trying to say the scenarios as in trying to predict stuff. I think it's really hard to predict. So I don't know. We have like Mr. Wo is I think it's technical. It's basically trading the markets, right? So if you have any scenarios or you are bearish or bullish, you can also try to help us out and can give some comments here. I don't know, others, you guys want to comment on this one? No one want to paint the story? Any bull bear story? China going to collapse story? There's all sorts of stories. Like you just have to like YouTube search the keyword and then you can find the scenarios that you want. You want a bull one, bear one, they are all available. It's just that if you want to watch the bear one, I think just type like crisis, crash, then it will pop up. For the bullish one, let's say like Singapore YouTuber, right? Maybe Adam Khoo is a good one to watch, or like Mr. Lu one also, he's very bullish on the markets. So I think you can watch those as well. So there are so many different stories.
I'll just say something. If you were to depend on other people's opinion, right, why not just look at those insider purchases? Means those company directors' purchases. They are more in touch with their industry. They are using their own money to buy shares. So there are plenty of people in the same sector. They are buying back shares. So let's take, for example, if there's a lot of property developers, for some reason they start buying back shares one fine day, and that because they are more in touch with the industry, and hence they are more. This indicator is slightly stronger than the opinions of maybe YouTubers or social media influencers. Yeah, that's my point of view. But when you look at market in general, how are you going to take advantage of maybe what you think of the market? Unless you're really buying the index. Other than that, you still have to go into the sector and look at the companies individually. That's my point of view.
Yeah, definitely. Thanks, Boon Song. Yeah, there are not just YouTubers, right? So I think that one is just the convenient one, and people usually make up good story, and then you can entertain yourself while like try to, basically listening to story, right? But I think I agree with Boon Song is that there are other better sources. For example, like all these insider trades, and also let's say just read the transcript for whichever companies that you're interested in, right? You can read the transcript, and then just from the transcript you can have a gauge on whether where the market is. Like they can talk about the performance of their companies, right? And then you can triangulate among a couple of companies, then you can roughly know like the scenarios, whether the situation is turning to the worst or turning like to recover in the future, right? So these are definitely good resources. Okay, let's move on. Hi, I saw your video interviewing Kelvin investing. Want to find out more. Since his options trading can generate 5 to 6K monthly, why do he need 1 million for FIRE? Actually, these questions, right, I haven't get like a plain or direct answer from him because I saw these questions quite late already. But based on my conversations with Kelvin, right, and this one I will add it together with my own interpretations. It could be that he disagree with what I'm going to say in the next couple of minutes. So the trading, right, the option strategy that he's doing, right, is basically like selling call, selling put options just to get some income, right? And he's able to get like 5,000 to 6,000 a month. Those numbers actually vary also depending on whether he want to take on more risk or not. But these are essentially active income, right? So he can't say that he just do nothing, just sleep, then he will get the money, right? It's not so easy. He still need to like watch out for the market, and then he still need to. It's a little bit active, like basically he need to do something on it, and it is a risk taking, right? It's not free money. For example, if you sell a put and then suddenly there's a huge crash, right? You have to really under stress to repair the trades and so on, right? So basically, this is like an active income. And of course, you can also say like, okay, he's doing his YouTube videos and then he can get some revenue from the YouTube, right? And then why he still need the 1 million, right? Since he's still working, he has the income, right? I think this one is same as any one of us. For example, if you are earning a salary, let's say you can get 5,000 to 6,000 monthly, right? You will still need the 1 million. Let's say your numbers. It's not necessarily 1 million. You still need, let's say, amount of money to fire, right, or retire, right? So I think that's what I try to differentiate between the active and passive income. When we say fire, right, whether it's 1 million, 2 million, 5 million, whatever amount, right? When we say fire, usually it means that this should be the amount of money to allow you to stop working, do nothing, and yet your financial is still secure, right? So this is the passive income. Passive income that's generated by your assets. Whereas for trading, whether you are selling put or whether you are your active income or whatever it is, your other revenue sources, right? These are considered the active side. So this is my interpretations. Yep. Anyone else want to add on this, or you have any opinion on active versus passive income or related topics? Yeah, different strategy, right? I mean, it's completely different topics when we talk about like, okay, whether it's 1 or 2 or 3 millions, how are you going to use that money to generate some passive income, right? These are totally different. I know among Singapore investor, there are quite a number of REITs investor. I saw some in the group in this call. So this is definitely different topics. So, but coming to this, I just want to stress that option trading, regardless of what strategy it is, right, it won't be a passive strategy. Even though you can say, I just sell a put and I just do nothing, right? Sounds easy when the things work out well, but it could be very stressful when things didn't work out. And that one, during those periods, you definitely will see this as an active things. And you, at the same time, you are risking your capital, right? So, if you are risking your capital, then you really can't say that capital is your fire money, right? Because if it is your fire money, suddenly you're risking a lot of money to earn a stream of income via your options, right? Those capital could wipe out, let's say during a steep crisis, right? So that's why I tend not to see this as a passive. It's more like active now. So that's on this question. Next one. Are you doing options now or recently? If yes, what are your option strategy at the moment? I don't want to comment on details on this question because, yes, sometimes I have some options just to earn some income, but I would say this is close to negligible. It's very, very small. I can explain why I don't do as much of options, let's say this year compared to the last year. Last year, right, the market is still like rallying up, right? So there's some, let's say, like support because of this bullishness on the market. So let's say if you sell put options, right, market is trending up, you have somewhat lesser risk. So you can just sell put, right? But this year, right, because the market has turned, the sentiment has turned, and if you listen to my past TCSS or my interview, right, with Sinhai or with Kelvin, I think I mentioned before, I'm on the bearish side. It's just that I don't think there will be a huge crisis, but at least I believe that the market should trend downward when the interest rate going up, right? So this is my expectation. So if I take that as an expectation, right, if I want to trade options, right, what I should do is actually to sell call options more, rather selling put options, right? Because I'm more on the bearish side. But selling call options, right, that's the problem, right? Because, if you sell call options now, especially market is weak, right? Actually, the income that you can generate isn't much. It's very, very small amount, especially for companies that I own in the multiple of, let's say, 100 shares, for example, like Apple, TSMC. It's very little. So I think I rather not to earn that money. It's just in case suddenly market just turn bullish, right? And my shares has to be called away, right? So I don't want that to happen. Whereas for companies like Tesla, yes, the implied volatility is slightly higher, but I don't have 100 shares, right? Meaning that even if I just sell one call options, if it really hard, right, I'm actually have a net short positions on the companies, right? Which could be painful if the market just really hard, right? Or really short period of time. So that's why I think the risk reward isn't that attractive. That's why I keep it like very, very small. I wouldn't say it's like zero entirely all the time. Sometimes there are positions, sometimes they aren't. But I keep it very small. It's almost like negligible. Yeah. So that's the options question. Anyone else want to add on this? Or let's say if you have any questions you want to ask on this?
Why not do spread?
Spread, I think I explained in the past, right? I think spread is good for those who want to bet on the direction. Like, let's say, you see, it's very different, right? Let's say if you sell a put options that is far out of money, basically you are betting that the volatility is lower. It is low. So that even if you are wrong on the direction, right? Say you sell a put and then it drops, right? As long as it doesn't drop below your strike price, you are fine, right? So essentially you are betting that the volatility will not be high. But if you are selling, you are trading spread, right? Actually, that one is not so much on the betting on volatility. That one is more on betting on the direction. You could have a bear put or bull put spread, right? I mean, those are really you are using options to leverage up your position. But at the same time, you want it to be kept at a certain level, right? That's why you use bull put spread. Or what kind of spread I think it doesn't matter, but it's more like you want to bet on the direction, hence you use spread. For me, I don't bet on direction because I don't know. I don't know the directions. I'm not doing technical analysis, like gauge sentiment and bet on the short term on the direction, right? So that's why I don't do that. It's okay for those traders. I think this is those like spread is kind of quite common among traders, I know. So if you want to bet on direction, that's your tradings. So it's something that I do. Okay. Other questions?
Sorry, Bhuti,
yes.
I have two questions if you don't mind. One is just now you mentioned this period is better to sell calls, right? So for yourself, do you still sell puts? That's question one. Question two is just now you actually wanted to ask, like, do you use technical analysis when you do options? And I think you briefly mentioned that you don't really do that. So how do you determine your strike prices when you sell calls or puts? Just curious lah.
Yep, thanks. On the sell put, right? Okay, once a while, let's say sometimes I will just sell some put options. For example, let's say when the market dip and then I saw that, okay, basically I don't look at TA, but I just look at, okay, there's some sentiment change, market dip, right? So I can sell put options that is far below and just earn, let's say, sometimes even as low as, let's say, $50, $80, that kind of money, right? That's why I say it doesn't like, I don't get a huge income from all this one. It's just like pocket money's $50, $80 here, but I sell far below the current price. And usually it's like very short term, 1 to 2 weeks. So that let's say within a couple of days, if market really drop, right, then I can just roll another week or two and further lower the strike level so that it will be very, very low probability that I will get hit. So it's more like just earning small pocket money here and there. But it's very limited. I don't have a lot of positions as compared to what I have shared, let's say, last year. Last year, I did like much more compared to this year. And if you watch I think one of the last video that I did in end of 2021, right, I actually shared how much I made in options. So I think that kind of earnings like is quite sizable compared to what I'm earning now. I try to keep my risk at very, very low level now. It's almost negligible at this moment now. So basically, I don't think I am using TA to say, okay, we are now at support level, hence it's okay to sell a put and just bet on the share price will go up, right? It's not like that. It's just to say, okay, now it drops, there's some retracement, and then I think that the sentiment already priced in a weak market, right? And that's when you see the implied vol also went up slightly, and then the share price also relatively cheaper compared to, let's say, a couple of weeks back, right? So just want to take advantage of the implied vol and then sell a very, very out of money put options. Usually I don't recommend people to do this. I think this is just like, collecting nickels in front of the steamroller, right? It will turn out well, let's say 90% of the time, but within that 10% of the time when it hit, right, it also like could be a painful one. That's why I'll do it on companies that I know and companies that have higher implied vol, so that I can sell like further, very far away from the current price. For example, let's say, just say Tesla, right? Tesla current price, I don't know, is close to $300, right? If I sell a put options, let's say with a strike of, let's say 220, could it drop to that extent within 2 weeks' times? Unlikely, right? That's why I try to like collect some premiums there, but it's really small. I would say, actually, I don't do that. I'm fine. It's not like a very attractive kind of trades from risk reward point of view, yeah. So
when you sell puts, you are at this point like you're not prepared to hold 100 shares of them, is it? You would rather roll them. Is that right?
Yeah.
Is it a bit of a naked put?
Correct. I don't usually sell put, and then if it drop below, then I just like take the positions, because I did that before with my Meituan, but that one also is a bit like error because I didn't know the Hong Kong exchange, the lot size stuff, right? So I made a video to talk about the error that I made on that. Usually for share positions, right, I don't want to mix up the options. So for options, let's say I sell a put options and then it dipped below the strike, and it dipped way below to the extent that I really have to like close the positions, right? Then I will just cut loss and just close that positions, because for me, right, I think the long-term portfolio that I have, right, it should be a portfolio that I buy over time. For example, you can see that let's say my positions, right, it could be like Apple or TSMC. I don't say, okay, now the price has dropped to 80, it's very cheap, then I go all in, buy 100 shares at one time, right? I don't do that. Usually I just look at the let's say the fundamental of the company at that time, and then look at the market sentiment, and then if I think that worthwhile to buy, then maybe I'll just buy like, let's say like $2,000. Then I will just like, okay, good for this month, right? The next month I choose another companies to buy, right? So essentially it should be a position that I build over time and not like in one go. For example, let's say just Apple, right, around $100+. But if you take positions of 100 shares, that's also like 10,000, right? It's not a small amount, right? For me, it's like if you build the positions over, let's say 2, 3, 5 years times, right? Of course, you can build a positions of 30, 50,000. But let's say in just one trade, you go and take a positions of 10, 20,000, right? I think that one is a bit too much for me. Basically, my profit or loss for that positions, right, is really depending on the timing of that trade, right? So I usually don't want to do that. I would rather to say, okay, if I like these companies, right, for the long-term portfolio, then I would just buy over time, so that at least I can get an average price along the period that I'm accumulating. So if I still lose money over, let's say 5 years, 7 years, right, then I can't say it's unlucky because of my timing already, because these are positions that I went in at different periods, right? For example, like Amazon, right? It's in the right now, but it's really the companies. Maybe you can say that my stock picking skill is so bad, right? So I go and buy Amazon at such a high price and accumulate during like long period of time. I will agree with that because I already accumulate over different tranches and yet it's still in the red, right? But let's say if you just do one entry, for example, like my Meituan stock, essentially just one entry and not average in over time, right? And that one is a huge red on my portfolio just because of the screw up on the timing. So the DCA part is really just to smooth out the entry price and not to subject myself to like the timing error. Yeah. So I would just to come back to the options is that I will really segregate the options part and on the long-term portfolio side now. So on the option side, let's say if I pocket all these like small monies, then I'll just pocket. But let's say if there's any losses, right, then I will have to like cut loss and just close the positions. So it shouldn't something that will make my option positions from a short-term options play for fun type of position. Suddenly it become like a long-term portfolio, right? So I think this is not recommended. At least for myself, this is what I'm telling myself. Jay, I hope that I answer your question.
Yeah. Thanks for sharing.
Thanks for asking the questions. Yeah, I said I don't want to comment so much on option because this is a long-term channel, long-term group, right? Actually, by right, we shouldn't talk so much on options. These are really short-term. I mean, it's a bit like for, sometimes you just want to get a bit of thrill. It's a bit like the gambling mindset. I admit that. So not recommended. We should all focus on the long-term. Okay, which is like accumulate your stocks and companies, the positions that you want, right, over time and build a large portfolio by doing it consistently and not via all these options. Okay, next one, thoughts on Nvidia headwinds and how will it get back on track to resume its revenue growth? So I think these questions, right, last week also someone asked this question and I say that for Nvidia it's very hard for me to comment. I would prefer YCX to comment because he always have good insights on Nvidia. But let's say this week he's also not here, right? So I'll comment a little bit here. During the last earnings call, right, I think Jensen mentioned that he's going to do something on it. Actually, I just watched actually there's this video shared on the group, right, that talk about this Jensen manipulating the markets. So I think that one is quite interesting. I also watched their earnings call and I didn't get, like the details of that statement coming from Jensen. He's basically saying that they will reduce the stocks or the products to the to the intermediaries in order to, I think, to manipulate the prices. I think that's basically the argument of that video, just to say actually they will try to control the prices by limiting the supply of the product, so that to control the price of the 30 series GPU down to certain level that they like. And then we know that within, let's say, one to 2 quarters, they will launch a RTX 40 series, right? 4000 series, right? And that, because the new product will be a lot better, right? So it should be priced at a higher level. But the 3000 series, they will be, they will still be on the market for some time. So I think the takeaway from that video is we know that they have inventory issues, and then basically what they are trying to solve this inventory issue by just let the RTX 3000 series to stay on the market for some time. So I won't be surprised, let's say, even until, let's say, mid of next year, we could still see that the 3000 series will still be on the market, let's say on prices that is below, because they still have to launch the 4000 series, right? If they don't launch the 4000 series, AMD will come and attack the markets, right? So that can't happen. They're already prepared to launch this one. They will do that. But the 3000 series will not be like, phased up immediately. So that's the inventory issues. Basically, they will, I think, over the next 1 to 2 quarters, the financial will still look weak because of this. But, if you look at the products, right, I think their product is still like much like it's a superior product as compared to, let's say, AMD. So I think this one you can get some idea from, let's say, those gamers. Then you will know that I think they still have a moat there. It's just that now over the short term, talking about, let's say, over the next 6 months, right, they will still have inventory issue and the financial will still looks weak. I think even it will hit their gross margin, right? So this one is definitely possible. But after they take, let's say, over the next 6 to 9 months, after they sort out all this inventory, right, I believe that they will go back to a growth period. But that one we are talking about next year, right? So if I'm in traders, I won't buy NVIDIA now. Or rather short the companies. So if I'm traders, because of the weak short-term outlook, right? But as a long-term investor, I also won't accumulate at this price. I think that during this kind of like weak sentiments, right, you don't know how much it could drop because of the valuation is also rather high. I won't be surprised if it dropped to $120 or even $100, So just this is how bad it is if you look at the valuation of the company versus the fundamentals and all these inventory issues, right? You will hit the financial. But over the long term, let's say talking about next year, right, I'm still bullish on the companies. So I'm still watching the price. Let's say it dropped to 100. I will, let's say, accumulate some, but not. I'm not too eager to do it soon. Or rather wait out, let's say, hopefully can get at a much better prices. But at the same time, I'm not selling. To me, right, if I have a short-term outlook, then I have to sell my portfolio. I think this is really, really tiring. Basically, I will turn myself into a trader, right? If I have a short-term outlook, then I just short or sell my companies and then buy back later, right? So you will just get in and out of the portfolio. So for those who are, in the group for some time, you know me, you will see that, my portfolio is like accumulation phase most of the time. It's only rare situation that I will sell the portfolio. But when I sell, usually I don't like sell a little bit like that. If I really don't have much conviction anymore, I will just sell the entire positions and just move my money to the other companies. So that's my plan on NVIDIA. I hope I answered these questions. Anyone else following NVIDIA here and just want to give your opinions? I'm happy to hear your view.
Maybe I just chip in some quick comments. I'm also a holder of NVIDIA shares. I think what we have pointed out is correct. Based on valuation at this point, I think it's quite rich and then it's quite high. So purely from valuation point of view, if the market wants to go down, I think I wouldn't be surprised if we hit 120s. And then from there, I wouldn't be surprised if it goes below 100. It may seem a bit crazy, but this is just purely from valuation point of view, coupled with the bearish market sentiment. That said, I am still bullish in the very long term. So for now, it's a hold for me. And then if it hit 120s or maybe even below 100, I may load up a few shares or two. But I think the caveat is NVIDIA has to show some signs of improvement, because at this point, personally, I feel the last earnings call, or rather the numbers are really quite terrible in my opinion. Yeah, that's all from me.
Thanks, Jay. I think I really share your sentiments. Exactly the same. I recall last year I did try to use discounted cash flow approach just to do a valuation on NVIDIA. Sometime, let's say last year, I don't remember when exactly, I can come up with a valuation of $200 for NVIDIA, but that's assuming that they are kind of extrapolating the growth rate, right? I think they are growing let's say, 60%. And I assume that they grow at 60, 50, 40% over the next couple of years, right? And I can come up with $200 or even more, right? Like $250 intrinsic value for that companies. But that is assuming, they can continue with that growth. And like what you just said, right? Their growth rate just suddenly gone, Suddenly, if you change your DCF and the growth rate, you have to plug in their actual current growth. And with all this inventory problem that I just mentioned, right? You basically have to assume a much lower growth rate, right? And then after all this growth rate, let's say drop to zero, and we still don't know how how soon they will recover and go back up. And when they go back up, will we continue to see that kind of like 50-60% kind of growth, or it will be like 10-20% kind of growth in the future? It's more uncertain, right? So if you factor that kind of like growth rate, right? I won't be surprised to say you'll come up with a much lower intrinsic value for NVIDIA. That's why even if you say it could drop below 100, right? This one also, I don't think it is like very bearish. It could definitely happen, right? But at the same time, why am I bullish, right? It's not so much on the gaming side, right? It's much more on the data center, because data center, recently I also read a bit more on the, like some innovations, for example, like DDR5 memories, then what happens what happened at the server side, the innovations that they're doing, right? So I think the entire data center innovations and improvement in the products, right? I think this one will still goes up at a very steep curve. So I think they will definitely do well on the data center side. I think it's a strong mode there. I don't think there are, let's say, like a second or third companies that are as strong as NVIDIA when it comes to all these applications or data center business. So that's why I'm bullish. But that one we are talking about like 3-5 years things, right? It's not about like 1 or 2 years. Whereas for the PC gaming, I think that one is really a mature market. So we really don't know, like given a mature market, once the growth rate slow down, hard to say. Then another thing is that based on the benchmark or league benchmark, right, coming from the RTX 4000 series, maybe the current slowdown is also because people withhold the purchase and just want to wait for the latest cards, right? So once that one come out, right, I think it's a function of how much the 3000 series will drop. Let's say the 3000 series drop a lot, right? Then maybe no point for those for the buyers to buy the 4000 series. So it will hurt their sales as well. So definitely there will be some impact. But let's say the 4000 series is really, really good, and then buyers still come back, right? They just temporarily pause their purchases because of the new GPU that's upcoming, right? And then they come back to the market and buys, and then that will also help with their sales. So I think it is couple of points to triangulate, but I think the bottom line is that the type of growth that we have seen over, let's say, like 2021, right, it's just like that one become like an anomaly, right? Something that is outlier. So if we take away that outlier, the valuation as of now is still like not cheap. So that's why you just need to be careful on that. For those who are still accumulating, I think please be aware of that. I wouldn't say that, we have to factor in the negative points as well, right? So that even if you think you are ready to pile in your cash and buy some shares and accumulate, right, you shouldn't be surprised if it drops. You just need to know. Because one thing I want to say is that we don't, within this group, we try not to say, okay, this is the company that I buy, I'm bullish on NVIDIA, then everything bad about NVIDIA is banned, right? Definitely we should talk about the risk also, right? So that we are all well informed. Okay, I think that's on NVIDIA. Let's move on to the next one. What have you bought recently during the dip? I think, I don't know. I will just share the screen here. I don't know. I think you can take a look. Let's see. So I think the dip, I don't know when you are referring to. I think June is the period that is quite low, right? And then that we have a small rally, and then now also market drop, right? So I think during, let's say, from April until now, these are the companies that I bought. These are all my existing positions, right? So I just built my position over time now. So Amazon, SML, NVIDIA, I think C Limited, this is the one that I sold, and then Microsoft, TSMC, and bought some Google. Nothing much. I think if you have any specific questions on the companies, maybe you can, coming week, you can just post some question, then we can talk about the companies in details. But for those who are interested to look at the trades, this is the trades. Okay. Where were we? And then I think just now we talked about the earnings, right? maybe I just go through a couple of slides that I pull in, and then I'll talk about the valuation. And I saw that Chicken just joined. Maybe he later want to debate with me on the valuation. I don't know. But let's quickly go through all this since we have some quick. We still have some time, right? So as this is the earning release. Whether it's a positive surprise or a negative surprise, I just want to take a quick look, right? So if we compare the Q2 versus Q1, right, I think there isn't that much of a difference. So I just want to say, let's say if this green line become lower and lower, and this purple line become, more and more negatives, right? What it means is that now we started to see that the earnings surprise tend to go on the negative side, and that one is usually very negative for the stock markets. But as of now, let's say just look at Q2, we haven't seen that now. This is the net figures. Actually, during 2021, you can see that although the market rally for not just because of the all this quantitative easing, right? Actually, on the corporate side also, you can see that maybe because of the during COVID period, people just expecting economy that is much worse now, and then it turned out that the actual situation is much better than expectations. Hence, there's more positive surprise. So positive surprise plus tons of liquidity, of course, market is going up, right? But now we can see that there's some normalizations. This is the normal levels, right? There's some normalizations, but not to the extent that like during 2008, where you keep on having negative surprise after negative surprise, right? So we haven't seen this kind of situation yet, but we don't know whether what will be the situations coming to 2023, right? So this is also something that's interesting to watch out. So I think Yardeni published this. I don't know how frequent it is. I think because this is quarterly things, this one should be quarterly. But his reports, right, some are weekly, some are monthly. You can just go to the website and look at the details whenever you like it. So this is the sources here. Then I just want to quickly talk about valuation, because whenever we talk about when we talk about this, right, whether the index should be at, let's say currently is ever around 17 times forward earnings, right? Whether it should be at 17 times or 22 times or 12 times, this is what we call the valuation, right? Whether the valuation now is cheap or not, right? We usually compare the pricing level versus let's say the forward earnings or the last 12 months earnings, right? Doesn't matter as long as we consistently compare across history. So, but valuations sometimes it's not just PE, right? Or P forward PE, right? There are different metrics to look at the valuation, and this website I think is really quite helpful. The source is here for those who are interested. You can just look at the source and look at it's very detailed. This one page, right, is just a summary. I'll just quickly walk through all these different there are 6 matrices here talk about valuation. I'll just briefly walk through them, and then of course if you have questions we can discuss a little bit more. So I think the first one, right, this is what he called the yield curve. Basically, he's looking at the yield curve, the slope of the yield curve. People when they talk about yield curve inversions, whereby the short-term treasury rate is higher than the long-term, right? So usually this one signal upcoming recession. And from the yield curve, whether from the slope of the yield curve, you can say that imply what kind of we will imply whether the market is expensive or not. But based on the yield curve now, I think the conclusion is that this is the conclusion. The market is fairly valued because it's within this, I think, 1 standard deviations. So I think this is the current positions. You see, it says that the 10-year rate is 3.26%, but then the 3 months is at 2.88%. So there's still a positive spread here. But this one, I think if given another 1 or 2 months, once the short rate go up further, right, to above 3%, right, I believe this one will turn out to be pointing towards market is overpriced, because the yield curve inversion just means that it's bearish. So you will compare the yield curve spread versus I think this is the, what is it? The standard deviation of the trend. Yeah. So basically you just compare against that. Just look at the yield curve and imply from that. So that's yield curve. Second one is buffer indicator. I think this one is also quite simple. This is just looking at the GDP versus the stock market, right? So you can see that this is the long-term trend. And then we are currently at about 1 standard deviations on the overvalued side. But overall, it's fairly valued now. I think not too long ago, let's say if we just go back to 6 months ago, right? Actually, we are at a strongly overvalued level here. So because of the current drawdown, right? It's actually came down, but still at the overvalued now. So this is Buffett indicator. Then the third one, which is what we just talked about, right, which is the PE. But PE also, there are quite a number of variations, right? If you just look at the past 12 months, I think that one is just the normal PE. But if you look at the forward PE, right, that one you take the price divided by the forward earnings. Forward earnings means that the estimated upcoming 12 months earnings now. And this is also a different one. This is the Shiller PE, or the cyclically adjusted price earning ratio. This one is basically looking at the current prices divided by past 10 years earnings. But the past 10 years earnings is not just the average. Actually, they just roll up with the inflation stuff. So this is a lot stable, because the earnings, right, year-on-year earnings could be very volatile, but if you average out across 10 years, it'll be a lot smoother. So this is also one of the favorite valuation metrics. So the CAPE is at 28.8, so it's like 43% above the long-term average of 20. So also point towards like slightly, although this is not slightly, this is really overvalued. You see, this is the current level now. So 2 fairly valued, 1 overvalued thus far. So this is a PE, Shiller PE. Then on the interest rate model, I think this one is, look at what, this is, this is just compared the yield, because, sometimes, let's say 6 months ago, right, the PE is high. But people will argue that actually, if you look at the PE of bond, right, because bond yield is a lot lower, right? So the PE of bond is even higher, meaning that bond is even more overvalued as compared to equity. Hence, using the bond pricing as a comparison, right, a relative pricing, right? You say that 6 months ago, stock market is not so expensive, right? So basically that's the argument. But right now, I think the bond yield also went up because of all this monetary tightening, right? So if the equity side doesn't go, the PE of equity doesn't go down as much, right, it will point to overvaluations. But if you look at this chart, right, I think maybe if you look at the website, you can look at how they calculate all this. There's a detailed methodology behind it. But overall, if you just compare the relative valuations, right, versus 10-year treasury, you can see that now it's just right at the historical trend line, meaning that it's not overvalued or undervalued. So that's on the interest rate model. And then margin debt. This is interesting because I don't think we talk about margin frequently. I think probably also the data is a bit, how to say, I think I can't say that this data is representative. I don't know how they get the data, but this is not like S&P 500 where everyone agree that okay, we just look at S&P 500, right? But when it comes to margin, there's more assumptions behind that now. But anyway, if we look at this, right, what they are trying to say is that, let's say in the past, when the margin debt amount is very high, that means the investor is very bullish, right? So they just borrow money and just take exposure on the equities, right? So that one always point to correction once the market turns downward, right? Then there will be margin call and so on. So when the margin debt is high, right, usually that is a sign of overvaluation. Market is overvalued. But looking at what happened in the past, let's say 6 months, right, you can see that actually the margin has dropped quite significantly. So if you, although here we are still at the fairly valued, meaning it's not that serious. Let's say if you just compare during global financial crisis, right, you can see that actually any margin call, any margin that will be margin call away, right? So this is what happened during that point, right? But now it has corrected from, you see the yellow line here down to 1 standard deviation below the trend, right? Pointing more towards undervalued, but not to the extent that this color changed to undervalued now. So I think this is also something that's quite interesting because once the market turn bullish, right, then when people are ready to take on a margin, take on more loan just to invest, right, then market will tend to correct and recover, right? So lower margin, that means that there are more room for them to borrow money whenever they want. Whereas for a period closer to, the yellow line or red line, right, that's when they are already overextended the amount of money that they can borrow. So this is also, I think, quite an interesting indicator. Then the last one, this is just plainly look at mean reversions. I think you see S&P 500 tend to trend upwards, right? So if you just look at the trend line, straight line up, then you can see that the variation around that trend line, right? Basically, this is the picture that we are seeing now. So you see during period around dot-com bubble 2000, this is when the market is very, very overvalued. And then it crashes, right? Even during 2008, it's not so overvalued if you use this metrics. And then, of course, now we have a small correction here. But if you just look at the mean reversions, right, actually we are not, people say that, okay, now there's correction already when market will bottom and it's cheap now. It is cheap if you look at just past 6 months, right? But if you look at longer period, actually right now it's still elevated. You see, we are now at the yellow line around 1 standard deviations, right? It's not like we are at this green level, right? So that's why we can't say that the market is cheap now if you have like a look at history over the longer period. So I think just to summarize, I think out of these 6 metrics, I think most of them are fairly valued. So if you look at this, right, 1, 2, there's one overvalued, right? I think the rest are all fairly valued. So yeah, I think if you just look at all of this, you will realize that actually market is, I would say, more on the overvalued side rather than undervalued by just looking at the chart level, right? So that's why looking at this, when people call the market bottom, I usually smile. I keep thinking that, let's say we are at this level, right? I mean, it could easily drop to the average and maybe even to this green level here, right? So definitely you can't look at this level and say, yeah, it's already bottom, right? Yes, it could, let's say if things just turn on the positive side, meaning that inflation come down and then corporate profitability continue to grow and then a job market continue to doing good. Of course, this one is the bottom and it could recover, right? Of course, it could happen, right? But if you just look at the history, current drawdown is nothing as compared to, period during, like global financial crisis and so on. So basically, this is just the valuation. Okay, I think I will just one last chart before I stop and then just see who want to discuss any other topics. Right? I think this one's in the group someone mentioned about Fed quantitative tightening and how many trillions it would drop, right? So actually these are informations that you can find on the internet. I think I forgot where I pulled this one from. But later I might share in the group if I can find. But basically, right now, Fed balance sheet is at about 8.5 trillions. There's actually a projection on how much it would drop, meaning that this is the level that I think Fed communicated that this is the level that they want. I think the Fed balance sheet is like a function of how much the GDP. Basically, they want to achieve a reasonable percentage versus the GDP. So at least over the next 1 or 2 years, they will continue to let the balance sheet run down. And then until they run down to level of around, I would say, let's say 4-5 trillion, around this level, then it will depend on the the economy at that time, right? So at least for 1 or 2 years, it will be just autopilot mode for the balance sheet run off. But whether they want to do more tightening or less, that one they will just use the Fed fund rates to control and not the Fed balance sheet. So they just want to put this on the autopilot and just let it go away at the background. So when people talk about this, there are just always different opinions, right? Some will say, okay, because of few trillions of balance sheet run off, basically you will crash the markets, right? Actually, I'm not too sure about that. It could happen. We should expect market to be weak because of the liquidity drain from the market, right? From the economies. but I just say that this is not a sure thing. It's not as simple as that. Yeah. So I'll just stop here. See, anyone want to just come back to the questions? I don't know who will submit more questions. Sorry, maybe Miss, you'll be resuming the Sunday sessions. Yes, the short answer is yes. Yeah, I forgot to set the schedule, so sorry about that. But come back to the valuation, or I don't know whether Chicken is still here or not. Maybe not. Maybe he's busy. And I saw YCX here. YCX, just now there's one question to talk about NVIDIA. If you want to comment, feel free. Any questions so far on, let's say, all this stuff about valuation or any model that we talk about here? If no questions, then maybe we're close to the end of today's sessions. I just want to end today's presentation with this one slide. So, when we look at all this market, and we look at market over, every week we try to guess, right? Oh, market goes up, market comes down, and then there will be weeks where we see, okay, market there's a rally, right? Okay, this is not a rally, this is just noise, 1.5%. But sometimes it could go up, right? Let's say 10, 20%, and then it crash another 20%. That kind of things always happen, right? But I think maybe for those new investors, sometimes you look at every 10%, you ask why 10% drop? You feel like, okay, you're so stupid, right? Because you bought at much expensive or high level. Or sometimes you just okay, I look at the chart, I think now is very low, I bought in, then market just rally 20%, and you think that you are a genius, right? I think this is definitely, very usual, very common kind of emotion. You have emotions. We all investors, right? We buy, and then we see that our positions in the green, always we are happy and we feel like we are so smart, right? This is totally normal. But I think over time, once you have some experience and looking at the markets, right, you will notice that actually no point to be happy when the markets went up, and even if the market went down, also don't feel that you are stupid now. So you see, this is coming from Jeff Bezos. He said that when the stock is up 30%, don't feel 30% smarter, because there will be period that the stock price will come down. So
yeah, what is the question?
Sorry, sorry, who's talking?
Yeah, me.
Oh, okay. Oops. I clicked something wrong. Sorry. Yes, I think I can hear you. The questions are, I think you're just talking about the outlook, right? Showing the Q&A. How do I go back? I actually don't know how to go back. Can sometimes share what's the questions on NVIDIA? Basically, what the outlook on NVIDIA. I think you can comment anything on NVIDIA. That would be great.
Oh, okay. Outlook now is quite bad lah. Yeah. Right. Outlook now is quite bad lah because of the China half a billion market cap loss. That's per quarter half a billion loss. That means a year 2 billion loss, right? Around there. Yeah. But at least that is going forward. It'll probably start hitting in about 6 months later or something. Yeah. That's one of the issues. Then for whether that's for the data center segment for China markets because of all these restrictions. It'll probably be across the board for all the semiconductors due to this restriction on things. Yeah. But then the other thing would be for gaming itself is more on the current gamers are very fickle. So for right now, they are thinking that, there will be a lot of, no one will be buying and things like that. But that is the kind of feeling that is the same feeling as during the 30 series, whereby they also said no one will be buying or whatever things. It's the same kind of understanding, but it will just depend on what the sales is going into December. It means once people are able to if let's say we are going to look at like earnings for December, right? Nvidia and AMD will have their earnings report in November, December, around there. So before that, you can kind of see during the earlier sales reports on what exactly is the sales amount for like Black Friday and other holiday sales things. And from there, you will be able to kind of forecast how their earnings will look like for the gamers thing, because they are all part of the holiday sales cycle. So that will be what determines how the demand is for this current year and going into January. Of course, during the months of during Q1 and Q2, the numbers will definitely be lower, because usually not Q1, Q2 and Q3, because Q4 and Q1 are usually the higher numbers one. Yeah, so that is how the cycle works. The only consolation from here will be that if let's say this year the sales is not good, it means that most likely next year the sales will be very good, because the average life cycle of GPUs itself is only about 3-4 years. So the people whom skipped out on the third generation and still don't buy the fourth, people will skip out on 30 series and still don't buy 40 series, right? By next year, they will kind of feel that their computers are kind of too old or too slow or whatever it is really. Like majority of them should feel that way. And then there's going to be more and more software that needs to come in, and you kind of need to upgrade your computer along. You can't be continually using that old thing unless you don't use any new software. So that is the outlook for this on the gaming segment and on the data center segment. As to whether there has been like some teasers on like new product launches and things, that one is kind of still in the rumor phases. But if there are some new products, if maybe Nvidia is trying to start a new product line, probably now and the next year will be the best time to start it. Yeah, I'm talking about things like the glasses and things. Because kind of like Google dropped the ball on that. And right now, that industry-wise, there has been a lot of rumors going around whereby some company here and there someone is going to pick up the ball that Google dropped and release some kind of AR VR glasses that is lightweight, not the type whereby you have to sit down and use it and it's like 500 grams on your eyes like that. Yeah, that's all.
Jensen actually mentioned about the reduced sell-in, right? Do you have any comment on that? Because initially I read the Q2 reports, right? I saw that sentence. I actually don't like appreciate the details of what, or actually the meanings of it. Because it seems that now they have inventory issues. I thought that he meant he will sell more and then just let the shelves clear all the stocks, right? But essentially he's trying to reduce like sales into this, like MSI, Asus, and so on, right? So I think the video that shared in the group yesterday talked about.
That's the thing. Actually, for inventory wise, when it's held by Nvidia, right, the idea of inventory is not very clear in terms of like what kind of inventory. Because when we talk about inventory, we can have like inventory in the sense that we have the actual made card, like the actual GPU itself that is ready to be sold to the consumer. That is like kind of like the finished inventory, whereby it's just put there and waiting to sell, that kind of things. But the other kind of inventory will be more of like is the components that make up the GPU itself, and those components can actually be repackaged, right, to make into other things as well. Like just take for example GPU itself. You have the GPU, that central chip, which is actually what you would think as the GPU, the whatever Ampere chip, like Ampere 102 or Ampere 104 or whatever it is. then there is those other things that are around, like all the memory, all the substrate, all these things. These are all actually all considered under inventory. Is whether you put them together to package them to sell only. And even if, let's say, the idea of, like, say, we are going to reduce the meaning of selling is that they reduce the number that they sell to the AIBs, which is typically how they push the product out, right? So when they sell to the AIBs, they're actually just selling the core chip itself, and the AIBs go and build up their own things around. Some of the AIBs may decide to use like better components or whatever. Like they could use better capacitors and things. This is up to the AIBs to do themselves, but the core spec and the core chip itself, that one is what NVIDIA is really holding. So for that, right, it is more reduced sell-in could be that the finished product itself, they don't build as many of it. But then you think about it, it will be that these finished products, they can actually just bin it into a different tier and then sell it later on as like more product differentiation and segmentation for the different buyers. That is how it is usually done. And the other thing is that now there's a lot of like negative press regarding these things, and the typical way of like going through about this is just to let time wear off, and then the new product comes in, then people will see that, oh, the new product is this particular price. Then they might think, oh, this price is too much for me, and I'm going to go for something that's cheaper and things. And then that's where all the different price points, some people will buy one at 200, some will buy at 300. So that's how they will segment out. But at the start, now it's more of like they reducing it so that there isn't so much supply that is going into the market that everyone will think that, oh, too many things and I'm just going to wait or whatever, that kind of things. Yeah,
I think I remember they... Sorry, I need to unmute a bit first. Can you mute yourself first? Yeah, I remember they have this contract with TSMC to manufacture all these chips, right? And then, sometimes they can change the contract and then reduce the order if they saw that the market demand is much lower as compared to what they expected, right? But I recall that TSMC saying no, just you have to deliver it. So I kind of feel that they have a lot of orders that they need to clear, but there are different strategies to clear all these stocks, right? They could just say, okay, I just flush the market. I just increase all the sell-in to AIB and I just dump it. Basically, you do whatever you want with it. You can price it at a much lower price if you want, right? Just clear the stock. But they are not doing that, right? So at one hand, TSMC will continue to supply them because of the order that they made. Then on the other hand, they say they are reduce the sell-in to the AIB, meaning that this, let's say like the 3000 series chips, right? I think they will just pack it and just take the time to really, over time, just clear the inventory over time now. So that's why I said the expectation will be that next year, probably they will still selling the 3000 series until mid of next year or even end of next year, right? Could be, right? Just different price segments, maybe cheaper price segment.
Yeah, definitely. That's the way. I mean, they can always just because when they receive from the TSMC, it's just that base chip thing itself. It is not exactly like the full finished product that they have to sell. It's still at the chip stage, right? And that chip stage can still move into different. There is the opportunity over there to move into different things, like supply more to like the data center or supply more to whichever area it is. Because the previous batch itself in the 3000, I mean the Ampere type, is that they actually contracted both TSMC and Samsung. They contracted TSMC for the data center chips, and they contracted Samsung for the consumer chips. So this time round is actually no Samsung at all, and it's full TSMC. So it is a bit more flexible in that regard, that they can actually just shift the stock or the product over to, say, supply the data center side or to the gaming side as and when they want, instead of like being that, like during the Samsung and TSMC side, whereby if you order from TSMC, you're definitely using that for server. I mean for data center. If you are ordering from Samsung, you're definitely using that for the gaming sector. Yeah.
Those chip can change one. I thought it's like data center is different.
No. It's the same, because you actually cut the silicon actually come in, and you actually cut the die out from the silicon, right? When you cut the die out from the silicon, I mean, because it's a contract, the full contract is together with TSMC, and how you cut the die, you bin it accordingly to like what you want to use it for, but actually you can repurpose them there to say whether you want to go into this or to that one. Yeah, it's just like how for the 3090, right, and the 3090 actually, like the 3080 Ti and the 3090 and the 3090 Ti, they're actually from the same chip itself. It's just how you bin it differently, and what are the other things that you want to put it, you want to put over there, like whether you want to disable some things, and whether the components around is you want to put whatever components around it. It's like, for example, the 3080 Ti and the 3090 Ti, right? They are actually the same thing. It's just that the 3080 Ti uses the surrounding parts are all actually cheaper, and they don't use the high end quality things. They use the cheaper one because it doesn't need to be that high end to sell that cheap.
Okay. Thanks a lot for the insight on NVIDIA. I hope that answer the questions on NVIDIA, because last week also there's someone asked about NVIDIA. I said, okay, let's wait for this week. Then, just now I quickly went through it. But it's good to get some insight from you, YCX. Okay, it's already 12 o'clock. Will bank gains from interest rates? I don't know who's asking this, but just a quick response on this is that I think usually it's yes, because as the interest rate goes up, right, it's not just the base rate or the so-called the bank's financing rate that went up. Usually it's also easier for bank to charge a higher spread when the interest rate goes up. This one, there isn't such a rule to say it has to be. It's just that based on experience, like we can even see that you could just compare today's mortgage rate compared to, let's say, 1 year ago, right? The base rate has increased, the spread also increased. At least this is what I observed now. So that's why this is kind of like based on experience, yes, but there's no rule to say that it has to be like this one. It's just that this is the norm now. Yeah, but of course, so this is like a generic questions, right? I think for you still need to ask like which geography that you're talking about. Is it like Singapore bank or China or US? There could be some difference there, and then each individual banks also could be different because some different banks, they focus on different markets, right? It could be like business loan, or is it like housing loan? Different banks, they have different exposure also. So I think this one, that's my comment. So I think thanks a lot to Jay, to YCX, to Typical Singaporean. He's not here anymore. Thanks for joining today's call. I think we will end the call now. It's already 1.5 hours. Then we continue next week. All right. Thank you so much, everyone. Thanks, Boon Song. Bye-bye.